Mr. Fired Up Wealth here. Thanks for stopping by. Today I want to talk about stock tips for beginners, but I'm also going to later in this video talk about a high-level methodology for the Fired Up Wealth plan. So please do stay tuned. For those of you that consider yourselves intermediate or advanced investors, I still do encourage you to listen to this because I think that you'll agree with most of what I have to say, and you'll probably hopefully learn a little bit along the way. For those of you that have already stopped by and have watched the first video.
Good start. It's a good start.
It's a great start.
Yeah, it's the first win.
The reason I started this channel is my goal is to retire in my mid-40s. I started my journey about 20 years ago, and really this video today is going to be, if I could go back in time 20 years and talk to myself 20 years ago, I would have said, these are the things that you need to do to be successful. Obviously not go back in time and predict you should buy Amazon or...
Doc! Marty! You made it!
Yeah!
Welcome to my latest experiment. This is a big one, the one I've been waiting for all my life.
Anything like that. Just the overall strategy of what I would have done if I would have started 20 years ago. And I kind of learned this along the way, wins and losses.
Defeating the naysayers. You're either winning or you're losing. There's nothing in between.
Right, but with that said, with the stock market, you just need to win a lot more than you lose, and you're going to be just fine. Before I get into kind of the approach that I think you should start with, I want to mention that you go onto Facebook groups, you go into different groups, and you see pretty much every day, I've got $500, I've got $1,000, I've got $5,000. Which stock should I buy? And you would hope that those people are simply looking for some feedback and some ideas, and that they're going to go do their homework and their own due diligence before they go and invest in these stocks. Sadly, a lot of them don't. They simply will do a poll, and whatever the top is, they'll go buy that. And that's not wise. That's not a wise way to invest your money. So the first thing that I would do is I would lay a foundation through two different steps. The first step is going to be education. Get educated as much as I possibly can, read as many books, listen to people that have been there and done that, listen to people like me, but not just me. There's lots of other people out there that have great ideas. And you should really take the little bits of nuggets of information from everybody that you listen to, every book that you read, and try to go make it your own approach. It doesn't, just because it works for someone doesn't necessarily mean it's going to work for you. With that said, I feel like the Fired Up approach can work for anybody, and if you're starting young, it's a very nothing's guaranteed, but it's a very good limited risk plan to get to the promised land and retire at a young age. So the first thing is education. The second thing is starting to put your money away into something that is sustainable, that will always be there, and that should always trend upwards. And don't be surprised when I say this. Don't think, oh wow, this is boring. Wow, he's just going to tell me to invest in this. Anybody can figure that out. This is simply where I would start while I'm trying to learn. And then you're going to get into different strategies, different approaches, different investment vehicles. So ETFs is where I would start putting money, and I'm going to give you 4 or 5 different ETFs that I personally invest in that are part of my core foundation. I've got different pillars within my portfolio, and one of the pillars is ETFs, and it's a mix of several different ETFs that balance out growth, S&P 500, and dividend growth investing. Okay, so it's going to be ETFs. And the thing that I want to mention, that I want to describe, so a lot of people, they want to just get rich right away. So they say, I've got $5,000. How do I turn it to $1 million in 2 years and I'm going to retire? Well, the reality is not many people get that lucky. There is some luck involved with that. And the best analogy I have for you is think of, and I don't know how many of you are gamers out there. I personally was a wowhead, World of Warcraft. I'm a 40-year-old guy. Used to play that game when I was in my 20s, late 20s, early 30s even. And, with Warcraft, or any kind of video game, you don't just fire up your PC or fire up your console and go right to the last, 25-man heroic raid.
Let's do this. Leroy Jenkins!
Oh my god, he just ran in.
Save him! Oh, geez, stick to the plane!
Oh Jesus, let's go.
Stick to the plan, Shove! Stick to the plane!
You don't do that because you don't have the experience, you don't have the gear, you don't have the skills to do that. You have to put in the time, put in the effort, build up the skills required in order for you to compete and to win the end game. And that's what it's really all about, is winning the end game.
I'm gonna live my life the way I want. I'm gonna win inside of every moment, and they can just find the most comfortable chair in their small house and sit back and enjoy the show.
So when you think about people that want to just jump into individual stocks and start buying options, they're really, trying to get rich quick, and they're not doing themselves any favors, because they end up losing their money, and it's rinse and repeat. They buy something high, they panic, emotion sets in, they sell low, rinse and repeat. People like me basically take advantage of opportunities like that, and those people lose their money, and other people gain from it. And I don't want you to be one of those people. I want you to win.
I'm by winning.
And so by investing in these ETFs, you're going to get the education and the skills that you need to start doing things like buying individual stocks, especially high flyer, high risk, high reward stocks, and maybe even options. Options aren't for everybody. Some people do great with options. It just depends on your personal preference. But options is not where I would start. And even if you decide to invest in options, for me, it's a very, very small percentage of my overall wealth. And I really do it as a side gig, almost like a game for fun more than anything. For me, it's not going to make me rich. Sometimes I hit some home runs. Sometimes I don't. But people like the adrenaline rush of it, because you can take, $500 and turn it into $5,000 pretty much overnight. And that's great. But not many people are ever going to build sustainable wealth over time and retire young by investing in, especially in options. Individual stocks is a different story depending on, if you're in blue chip stock, et cetera. But do yourself a favor and invest in dividend stocks, okay? Warren Buffett says it. He tells you to invest just in S&P 500 and that's it. I don't completely agree with that. And I think that you need to invest in those individual stocks to make sure that you have outperformance, and you're going to take that outperformance, you're going to sell it, and you're going to invest that outperformance, those earnings, into dividend stocks that are going to pay you dividends forever. And you're going to live off of those, and that's how you're going to retire. But if you just start putting money into dividend stocks today, you could get there in 20 years, but it's going to be a lot harder. You're going to need some kind of growth to help accelerate that. But let's not get ahead of ourselves. So the first thing I would do is I would read this book, The Little Book of Common Sense Investing by John Bogle, also known as Jack Bogle. He is the founder of Vanguard. So really the inventor, the pioneer of the ETF, modern day ETF. Vanguard has great ETFs. So does Fidelity. I personally use Fidelity, and I like their BlackRock. So you can do iShares, BlackRock iShares, and there's no cost to invest in those ETFs, and there's no commission. And the reason that's important is when you're starting out young, you probably don't have $5,000 at a time. You might have $100 or whatever. You can go buy $100 worth of stock, worth ETF, like an IVV, an ITOT, a DGRO, and I'm going to get to those in a second, and not pay a single cent of commission. Otherwise, it'd be $4.95. Obviously, if you put in $100 and you're losing 5% right away and you're already down 5%, that's not really a good way to invest. So this allows you to dollar cost average into that index fund, but it also allows you to put really as little as you want, as much as one share costs. So if a share is $40, you can put in $40 and buy one share, and there's zero commissions to buy it through like a Fidelity, or you can be with a Vanguard, that also has a similar, the VOO, the VOO is the equivalent to the IVV. IVV is the iShares, so you get that through Fidelity. If you're with Vanguard, you can get the VOO. Both of those are S&P 500 index funds. So the first one I want to talk about is the IVV. It's an S&P index fund, has a very low expense ratio, very comparable to Vanguard. You can take a look here, and you can see kind of what's inside. of that, the basket of the basket of stocks that are held within that portfolio. And obviously, it's going to have a lot of the FANG names in all these ETFs. That's one thing you'll notice is they're going to have a high concentration of Amazon and what have you. The way I balance that is with DGRO that you'll see here. That's DGRO. That's a dividend focused ETF. It's not really dividend growth because they didn't have an increase in dividend last year, but that's a whole other story. But the thing about ETFs is that they're going to constantly trend upwards. And in 5 years, 10 years, 15 years, we might have a bear market. That's okay. You keep putting money in consistently. Now you're buying it at a lower cost. Eventually, the market is going to trend upwards. It might be a 5 or 10 year, bear market. You can't predict that. But one thing is true: if you go, the only way you're going to go 20 years and it's not going to be higher is if the United States, doesn't exist. The world has some kind of a, zombie apocalypse. But then you're going to have a lot bigger problems. Kind of like Rick and Michonne. And AMC's Walking Dead that you'll see there. But the ETFs are going to give you a way to kind of lay that foundation, get the education, and it's going to allow you to figure out what you're doing. Those ETFs you can hold forever, constantly invest in those bi-weekly, monthly, as much as you possibly can. Some people like to build up cash and they'll wait for a dip and then they'll throw all, that's a good strategy too. If you're not disciplined, you don't have the time to do that, just bi-weekly or monthly or whatever you can do, have it right from your paycheck right into your brokerage account and have them put it right into whatever ETFs you choose. The other one that I like is ITOT, ITOT, and you'll see that there. It's basically the same as the S&P 500. It's just a larger index. So instead of the top 500 companies, it's the top 1,500, I believe. So this gives you a little bit more diversity. But when you look at performance over the last several years, it really they're really not a whole lot different, pay similar yield. But all these pay yield. The other one I really like is the QQQ. That one's going to be more of the high flyer. It's got a very low dividend, like 0.75%, less than 1%. It's going to have things like your Salesforces, your Amazons. It's still going to have a large concentration of FANG, even more so, and just a lot more of the risky stocks, biotechs, or the NASDAQ type stocks. But I do have that as one of my core positions for growth within my ETF pillar. Getting now into the methodology around Fired Up, you're going to lay a foundation and you're going to invest in ETFs while you're learning. You're going to learn as much as you can, read books, attend seminars, learn from other groups, learn from people like me and tons of other people out there. And then as you get comfortable, you start to invest in growth stocks, high flyers, but you're gonna have a kind of a foundation in those ETFs. Now you can start using what they call mad money to put some money into some higher risk stocks, hoping that you're going to outperform the market. You're then going to eventually cash out that high growth, and you're going to take that profit, that outperformance, and you're going to reinvest that into dividend paying stocks that you think will be around for 10, 20, 30, 40 years. And obviously you still have to, monitor your stocks and make sure, you don't get in a situation like that. But I hedge that by having 1%. There's a few stocks I have a little over 1%, but I try to keep every position 1% or less. Obviously you're not going to do that when you have a smaller account, but when you start to get a large account, having 1%, if that stock tanks, it goes out of business, whatever, the most I'm going to lose is 1% of my net worth. And obviously I still do my homework. So hopefully you're selling way before anything like that would happen. If there's a 10%, 20% dip, maybe, the news changed, the story changed in the company, maybe you sell it, and there's a very low chance you're ever going to lose that full 1%. But even if the worst case scenario happens, you're very hedged because you only have 1% invested into that individual stock. So it's going to be a blend of ETFs, high flyer stocks, and then individual dividend stocks. And as we do more of these videos, we'll break down that strategy a little bit more. But if you are new, I want you to start by figuring out the best ETFs for your brokerage, or maybe you need to switch brokerages. Start doing some homework. Pick up a copy of this book here. You can get on Amazon. I think it's like $10 or something. It says 25, but $25. Check it out on Amazon. It's a very good book. When you're reading this book, do yourself a favor though. Don't take everything that he says in this book at face value. Take it with a grain of salt. The reason I say that is he's very old school. I believe in the Bogles and the Warren Buffetts and the Grahams. That's part of who I am, but I'm not completely sold on all of it either. So, Bogle will tell you that you should have, some of the stats are like, 50%, at my age, I did 50% in bonds. And that might have been the case, 10, 20, 30 years ago. But when bonds are paying 2%, me personally, I have this conversation with friends all the time. I'd rather put it into an AT&T paying 6.5%. And even if AT&T doesn't go up, I'm still outperforming the bond. That's just me. Everybody's got their own path. But what I'm getting at is when you read this book, just make sure that you take it with a grain of salt. What I think this book will do is it'll make you realize it's harder to beat the market than you really think. It's going to make you think very hard about your strategy, and it's going to hopefully make you believe in ETFs, at least to be part of your overall strategy. I do believe that ETFs are important to be a part of your core of your strategy, and that's what I would have done 20 years ago. I did not do that. I did what I told you not to do earlier, and I invested in individual stocks and tried to do all kinds of crazy stuff, invested in businesses that didn't work. I can go on and on. And that's why I'm here. I want to, if I can help just a couple of people at least think hard before they make a decision they might regret later, I'll feel good knowing that I could do that. So if you like these videos, please do subscribe. I'm trying to get a subscriber base. Share this with anybody that you want to share it with. Make sure to like and comment. And in the comments below, I would really like to see some comments of what you would like to see from me. I've only done 2 videos before this. This morning I did a Fastly chart video. That's just a company I like that you can check out. And then of course I did the introduction to Fired Up Wealth a few days ago. So this is really my 3rd video. It's my 2nd video of a series dedicated to the Fired Up Wealth strategy. And I will be doing another video next week that will continue this conversation with the Fired Up Wealth approach and what I would do for the phase 2. So we just talked about phase 1. Phase 2 will be next. Encourage you to check out my website. I've got a blog on there. I've got an overall methodology that kind of spells some of this out in writing under my website. So go to www.firedupwealth.com and then go to the methodology link. And then also I do have some stories on Medium if you follow Medium, so follow me on there, and then on Twitter as well, at Fired Up Wealth on Twitter. So have a great day. Thanks for your time. I hope to hear from you in the comments below, and have a great weekend. Thanks all.